Hello and welcome to today's special investor briefing with Healthia CEO Wesley Coote. It's terrific to see so many people that have joined in today online. My name is Samantha Fraden. I'm from Principal IR and I'll help Wes run the session. I'll just quickly run through the formalities. So after the presentation, Wes will be taking questions from attendees. If you do have a question for Wes, there is a sidebar on your screen which says Q&A where you can enter the questions throughout the presentation. If you're on a smart device, however, that will be on the bottom of your screen. Since listing Healthia on the ASX in 2018, Wes has led the business to become what is now Australia's fastest growing allied health portfolio. Wes, of course, has been very generous with his time to present Healthia's half-year results and upcoming plans for the remainder of the financial year. So without further ado, I will hand over.
Excellent. Thank you, Sam, and good afternoon, everyone. And welcome to our H1 FY22 results call. Again, we've gone through another 6-month period of a lot of challenges around COVID. They've been on a number of fronts, but mainly around lockdowns and restrictions imposed by the governments in the first quarter of the year. And then we went into some mandatory vaccination and mandates around there. We had to manage and most recently into a wave of COVID, which we hadn't seen in Australia and definitely not in Queensland before. So it was a challenging 6 months, but our teams have done an amazing job. They've shown up every day for their patients. And we're pleased to be able to say that we've delivered growth on prior periods. So revenue growth, despite those lockdowns, was up 50% on prior period. Our underlying EBITDA was up to 12.2 million, which is up 11% on the prior year as well. During the period, we also made a lot of acquisitions. So we deployed $102 million worth of capital for 76 physiotherapy clinics, 3 optical stores and a podiatry clinic. Inside there was the large acquisition of the Back in Motion portfolio, so 63 Back in Motion physiotherapy clinics. That acquisition further expanded our geographical reach and that reach into New Zealand as well. And it positioned us as the #1 physiotherapy group in Australia and New Zealand through that acquisition. We also recruited 154 new graduate clinicians in the last period as well. That's up from 64 in the last period. It may look like a large increase, but keep in mind we have 76 additional physiotherapy clinics, which we didn't have last year at the same period as well. And the majority of our grads end up in our physiotherapy clinics. So they were all onboarded in February, went through our structured graduate induction program, and they're all now in their clinics working away. During the period, we made the very conscious decision not to make many changes to our rosters, and I'll get to our division splits later on in the presentation, and there was varying impacts across them. But that also had an impact on the overall group margin. So group EBITDA margin was 17% in last year. It was only 13% this year, largely driven by the impacts on revenue from the lockdowns in Q1 and the choice that we made not to make any major changes to our rosters through that period of time. So with that, and with the large number of acquisitions that we've made through the period, there's a lot of noise in our numbers, and we do appreciate that. So what we've done here is the third dot point down. We've given an EBITDAX number. So the first time that we've really provided some guidance to the market, and what we've put there is given the stabilising of our performance as we start to push through the back end of this COVID wave, and the large number of acquisitions we've made, we've put out there a number on our exit run rate for FY22 or our starting run rate for FY23. So our expectations are that we'll deliver an annualised run rate of $40 million worth of EBITDA. So that assumes that there's no material impacts from COVID-19 as we push into FY23 and we resume back at normal trading levels. So we've put out there, just to repeat myself, we've put out there an FY23 starting run rate on our EBITDA of $40 million. Just push through to these slides here, and they just show the impacts that we've had over the last 6 months. So the first graph on your left-hand side just shows the number of clinic days that we were impacted during each of the quarters. So if we go back to Q1 FY21, you can see that we had less than 2,000 clinic days impacted in that quarter. But if we push through to Q1 FY22, you can see that's nearly 6,000 clinic days that were impacted. We then had a few in quarter 2 of this current financial period as well. How did that translate to same clinic growth over that period is on the right-hand side. So the dark blue bars being the first quarter of 22, the dark grey, the second quarter, the light grey H1 of this period, and then the yellow really comparing it next to last year. Last year was an extraordinary stimulus-led, pent-up demand led 6 months. So there was extraordinary growth in that period. So 14.5% like-for-like group growth in that period versus negative 9% organic growth in the last 6 months. But if we go back another period and if we were to compare H1 FY20, we've still comped sales growth over 20 into 22. This here is broken up into divisions. What you can see there is the largest impacts were felt in the lockdown period in our eyes and ears division or our optical stores. Those stores are very recall, reminder, routine, eye check driven. And when we were in lockdowns in New South Wales and Victoria, the Optical Association said emergency care only. So it meant we had to turn off our recall and reminder programs and see essential emergency care only. So it lowered our comp sales growth by 33%. But then when we rolled into quarter 2, we could see there was some pent-up demand that came through and we were starting to comp sales growth again through that period. On the lesser extremes, our physiotherapy clinics, where we had 3.2% down on the prior period, but 15% up on the period before that we're comparing to, but minimal impacts through both quarters, just given the way and the way that the cycle of revenues generated in those businesses. So this just demonstrates the different effects that the lockdowns had on the different parts of the businesses, in quarter 1. And I'll go into a little bit more detail as I touch now on each of the divisions. But our feet and ankles division, which is largely our podiatry clinics, the revenue for the period on a like-for-like basis was down 9%. So partly there's a part recall and reminder program in there around our orthotics, which we had to turn off in Q1, which had some impact. But we also have some retail footwear stores. So our Natural Fit stores were closed pretty much for the whole of the first quarter. We've got 10 other retail footwear sites with podiatry at the back that had some impacts and some flow-on effects from lockdowns as well. But what you can see here, if we go over to the grey boxes, then the second box down on the left-hand side, our underlying EBITDA margin was 19.5% for the whole of the half. But if I break it into the 2 quarters, the first quarter was at 14.8% and our second quarter was at 23.9%. So the 23.9 is in line with expectations. So the second quarter, out of the lockdowns, we had a pretty good run of things until we ended up in this current COVID wave, which was the last week and a half of December. But you can see there, margins rebounded back to where our expectation were, which was at 24.9%, so 23.9% in that quarter. Another highlight or another thing to call out in our eyes and ears, or our feet and ankle division, is our orthotics business. We've previously mentioned that we've got a lab in the US which we print orthotics for the wholesale market over there. We now that COVID's nearing or somewhat behind us and borders are opening back up, we expect to start to expand those operations now that we can get back into North America and focus on that part of the business. So we've got to focus now on getting back up to North America and expanding that part of the business. We were also awarded a $2 million grant from the Australian government to support some research into design-led smart orthotics to bring into regional and remote parts of Australia that essential service. So it's something that we'll continue to explore over the next 12 to 18 months. Our bodies and minds division, as I mentioned before, was the least impacted on lockdowns. Traded it quite well through that period. There was still off about 3%. But if we look at it over H1 20, so if we go back a year before that, we're still comp sales growth of 13% over that base of the FY20 year rather than the FY21 year, where we know it was stimulus led and there was a lot of pent up demand across all industries. Large growth in this division really comes from the acquisitions. As I mentioned on that first slide, 76 new physiotherapy clinics in the last 6 months, 63 of those being the Back in Motion clinics that settled between October and December. So earnings did come in for those clinics over that period of time, but they were only there was only a small portion of it, so it wasn't for the whole period. But what that led to was revenue growth in the division by 65%, EBITDA growth of 46.9%, margins slightly lower than where we'd expect them to be because of some of the impacts on revenue. But at 18.4%, it's not far off where it was last year, and still a couple of basis points higher than where it was in FY20. Our eyes and ears division, keep in mind we're comparing last year, and we only had 1 month's worth of actual results for the eyes and ears division. So the Optical Co was acquired on the 1st of December 2020, which meant that division only kicked off on the 1st of December 2020. So only 1 month's worth of revenue and earnings in the prior period. So that's why the revenue growth of 340% is so high. So just keep that in mind when we're comparing it. I think the call out here was really around the clinic organic growth, 33% down in that quarter. So the largest division affected by lockdowns was our optical division, but comped 2% sales growth in the second quarter. And then it's a story of margin, tales of two stories in the margins as well. So EBITDA underlying margin of 22.8% for the whole 6 months. But the first quarter delivered only 9.7% because of the impacts on revenue and us continuing to pay all of our team members during the lockdown period and not laying people off, versus 31% in that second quarter. So the second quarter was in line with our expectations for the division, and we were pleased with the results that came through in that quarter, where there was minimal COVID effects in that period. A call out there is just our vertically integrated business of the AED eyewear products as well. We've increased those sales to 50% of all of the sales in that division. And we've really worked hard on making sure there's key steps in our integration of new stores, and we're introducing those products well, and we're getting the uplift in GP margin in our newly acquired clinics by pushing our product through there. So that's been a great success over the last 6 months, and as we integrated the TOC businesses. We also entered into an agreement with Bupa. So we're a Bupa optical partner, and that partnership only extends across 4 groups: so Specsavers, the Bupa optical clinics themselves, another small group, and ourselves. So that was a good win for the group in the last 6 months as well. As I mentioned before, our team members came first. We made the decision to hold the line during the COVID lockdown periods, not let that affect our team members' take home. And we've got the rewards off the back end of that. As you can see, our clinic retention rates have remained in that 90%, so 92% previously, but still remain in that 90%, which is really good. We know a lot of industries across the country are experiencing staff shortages and staff issues, but we've been able to maintain a clinic retention rate of 90%. So that's why we're seeing good rebounds off the back of lockdowns or COVID waves. We're seeing the businesses rebound back to where they need to be, because our teams are core to what we do and core to our success. And we looked after them through the COVID period, and they continue to look after us and look after their patients as we've traded through that period and out the back of it. Other initiatives we've put in place is really that clinician retention program, which we've talked about before, which is our program where we allow our clinicians to come through and co-own next to us. That program's increased over the last 12 months. Some of that's driven by the Back in Motion clinics coming in, and every one of those clinics having clinic partners as well. But that program continues to expand as we go forward. We've brought on our new graduate clinicians, which I mentioned before. They're filling some vacancies of that 10% that we've experienced. They're also there for our organic growth as we push forward as well. And we've spent a lot of time on education and professional development for our team. So well-established programs now through the portfolio that are driving good training hours for our teams. Financial performance, so just quickly touch on that. Revenue at 93%, so as I mentioned, up 50% on prior year. Underlying EBITDA up 11%. And then some impact there from timing of finance costs and non-controlling interest, which saw pretty much net profit after tax pretty similar to the prior period, so 4.6 versus 4.7. So the margin, the decrease in the EBITDA margin from 17.8 to 13.1% due to the impacts on revenue in the first quarter and us holding the line on that fixed cost base has really driven things down. But we've called out there the fact that in that second last dot point that our margins in the second quarter were at 16%, or 8.6 million of the revenue was driven in that period. And those margins, as we stabilised, were as expected across that period of time. So as we saw ourselves recover from COVID lockdown and restrictions, we got back to normal trading. But unfortunately, we then hit a COVID wave. We saw some impacts through the back end of December into January, and then again into February, which I'll talk about and touch on in the outlook in a second. You can see here that over the last 3 years, we've continued to deliver on our growth promise. Revenues up 110% from FY20, and EBITDA are up 112%. So our focus on acquiring good, solid clinics, as well as our organic growth, has helped us deliver over the last 3 years growth for shareholders. Cash flow conversion remains strong. You can see there our cash flow conversion at 100% and 91% in the prior periods just demonstrates the really high cash conversion rates that these businesses have, which is great. We always also get asked a lot about how capital intense the businesses are. You can see there 1.6% of revenue goes back to maintenance CapEx versus 2% in the last period. So we expect it to sit around that 2 to 1.5% annually. During the period, we did increase our finance facility from 70 million to 100 million. We extended the term of that as well. So we're just under 3 years of term left in our facility. Our key covenant with the bank is our leverage ratio, or our debt to EBITDA ratio, of less than 2.5%. For the first time, we've also shown that it's set at 1.89 for the period based on how we report that to the banks. That period had COVID impacts in it as well. So no normalisation for the COVID impacts, but we sat there at 1.89 times, which we've still got headroom to get up to the 2.5. So of the 100 million facility, we're drawn to 70 million. So we've got $30 million worth of facility, and our key covenant is sitting there at 1.89. Our strategic growth imperatives haven't changed. We're still looking to deploy $20 million worth of capital per annum on accretive acquisitions. We've got a lot of organic growth activities in place as well that we're looking to continue to build upon, which has driven some of the organic activity in the past when we haven't been in COVID lockdown situations. And what I can say is in November, when we had no COVID impacts, which has been the only month pretty much of this whole year without any COVID impacts, we had 5% like-for-like growth. So we'll continue to target 3 to 6% like-for-like growth year on year when we're not in impacted periods from our cross-referral programs, by co-locating podiatry and physio or audiology and optometry, expanding our services. We now have OTs and speechies and exercise phys inside of our physiotherapy clinics, through our targeted marketing programs, and through populating and growing our workforce. So that 154 graduates that we've brought on over the last couple of months. Our vertically integrated businesses are working well for us. As I mentioned before, 50% of our sales are now our AED products in our optical part of our business. We're continuing to expand our capabilities in eye orthotics and our 3D printed orthotics, as well as our DBS business there as well. Our key then retention programs of our clinic class share or our clinic partnership model and our education as well, to drive that retention rate and keep that retention rate around, above 85 is where we really want to be moving forward. So just finally, I'll just finish up on a trading outlook and an update for FY22. We expect to continue to deliver growth over FY21 in the second half, while we've still felt some impacts in the first couple of months of this second half from the latest COVID wave. January was down about 25% on a like-for-like basis, and then it's steeply recovered as government mandates and government restrictions changed. So instead of being 14 days in isolation, back to 7, in close contact back to household. We saw that. We saw revenue recover quickly there as people came quicker back into the workforce, and less cancellations from our patients. So we've seen that improve week on week, with Feb being 4% below now on Feb 21, and last week improved again on that. So we're expecting from March onward, we're back to nearly normal trading conditions. And once we get back to those normal trading conditions and we're comfortable with where we sit for the rest of the financial year, we'll give the market an update on where we think FY22 will land. But what we did know was, with the large amount of capital that we've deployed this year, so $110 million with the acquisitions that we've announced post half year as well, and with some of the noise in there from the lockdowns at the start of the year and now the latest COVID outbreak, we thought it was important to set that guidance for FY23. So as mentioned at the start, we expect to commence 23 with an annualized portfolio of greater than $40 million worth of underlying EBITDA. So that assumes no major impacts from COVID as we push into FY23. And we believe that will be achieved if there's no impacts through that continued focus strategy, which is acquisition growth, our acquisition. So continue to target that $20 million of capital deployed through those very strategic organic growth activities that we have in place that we've talked about further, and through driving our vertically integrated business units. So we'll continue to also focus on training and inducting our 154 new graduates They've all gone through their initial training, and we expect them to operate at an acceptable level of capacity by the end of, by mid to end of April of this year. We've deployed outside of the Back in Motion acquisition. We've deployed nearly $19 million of capital this year. We've said $20 million, so we've got about $1 million of capital deployed before 30 June. We're very comfortable with it where our pipeline for acquisitions is at, and that we'll be able to deliver that extra $1 million worth of capital. We'll be able to deploy that. And then into the next year, we're still comfortable that we'll be able to deliver or deploy $20 million worth of capital on acquisitions in FY23. And just finally, before we take questions, a new acquisition of Back in Motion settled in that October-December period. And our focus is to continue to integrate that business into our systems, which is going well as well. So that'll continue to be a focus as well. So that's an overview of where we were at for the last 6 months and where we expect to be heading in the next 18 months.
Great. Wes, well done on the strong results, and thank you for the informative presentation. I've already had a couple of questions come in, which we will start answering in a moment. If anyone does have any more questions, just type them into that Q&A box. Some questions have come in multiple times or are very similar, so I'll couple a few together as we go. So Wes, the first question I have here is, can you provide an update on how the US operations are faring and what growth you're expecting from the market there?
Yeah, look, it's been steady, the US operations, because we put the lab over there in New York just as COVID hit. So unfortunately, the timing wasn't great. But the business has steadily grown over the last couple of years. But now that the market, the borders are open, we'll get back over there and we'll aggressively look to grow that business. So look, nothing that I can give solid growth numbers on right now, but I'd hope by the time we get through to the end of this financial year, a little bit more would have transpired, because we would have been able to go over there and do a little bit more planning, and we'll give a more solid update as we finish FY22.
Great. Someone else has written here, nice grad program numbers, but what is the graduate retention rate once they've completed that program?
Yeah, look, they all stay on board. So the graduates are employed to go into a clinic and where we've got need for them. So it's 100% in straight away. We're not just training them and letting them go out into the world. They've got a purpose or a clinic that they'll go into. So and then they just roll into our normal retention rates, which have been about 90% over the last 12 months.
Fantastic. Are the clinics still on reduced trading hours, or are we back to normal now?
No, back to normal. We didn't reduce hours even in the lockdowns at the first, at the start of the financial year. Team members still came, showed up every day. It was just we had reduced volumes because of some of the work that we could see, or the way that we typically bring in work. You could see eyes and ears was down 33% because we couldn't send out reminders and we could only see emergency essential care. So we didn't reduce hours as such. And the impacts we've had in this wave isn't around reduced hours, it's around staff absenteeism and patient cancellation. So if a patient gets COVID, they can't come in, so they're cancelling, or if a team member's getting COVID or they're close contact, they're cancelling. So we're an inverse effect to the wave. So when the wave was the highest is when we were having the biggest impact. But now that we've come off the back of the wave, we're progressively getting closer and closer to same store growth each week.
Great. Another question here. Does HLA make any material revenue from online sales of shoes and glasses, or is it all run through the clinics? Is this a market that Healthia can increase sales based on the increase in online spending throughout COVID?
Yeah, look, we've got minimal spend on online at the moment, and it's definitely a focus for the future is to increase our online sales in both regard. We've been very focused on delivering the services from our clinics more so, but I guess what COVID did highlight in our feet and ankles division was the impacts that happened on our retail footwear part of the division. So yes, definitely a focus in the future to increase our online sales. We do make some, but they're immaterial to the overall group at the moment. So we do need to increase those sales over time.
Of course. Another question here from Lawrence. Would rising interest rates impact your 20 million capital deployment for acquisitions?
No, not at all. We've, as we mentioned earlier in the presentation, cash conversion's 100%. We've said we'll do $40 million worth of EBITDA next year. We want to deploy 20 million. So we're not relying on bank debt or focused totally on interest rate increases through CPI increases or interest rate increases. We're comfortable with our funding mix, where it's going to go into the future, and our ability to deliver that $20 million of capital per annum.
Fantastic. What is a smart orthotic? Will they still need to be replaced every 1 to 2 years?
Yeah, look, smart orthotic is something we're penning and we're developing. It's one that will assist the patients, especially diabetic patients, with some of their conditions, and will tell us when the patient needs that orthotic looked at is part of it, because they'll be in remote areas of the country. So yes, they'll still need to be replaced on a regular basis as well. So it's not something that will be something that they get and it's indefinitely there, but they will definitely need to be replaced, probably more regularly, because the device will be telling you when something needs to be offloaded or needs to be changed in that device. It is an R&D project that we're right in the middle of at the moment, so we will give more updates on that as that project progresses.
Interesting. And I've got a question from Andrew here regarding the annualized portfolio EBITDA of 40 million. What is attributable to HLA shareholders? What is attributable to clinic class shares?
Yeah, look, the clinic class shareholders are around that 25% of the portfolio at the moment. So, 25% of that 40s to clinic class shareholders, and then the other 75 to Healthia shareholders.
Fantastic. We are running a little bit tight on time, so I'll wrap up the questions there. Wes, thank you so much for your time today. If anyone has any further questions, just feel free to email them through. And don't forget, a recording of this webcast will be made available shortly on the Healthia website. Wes, on behalf of all investors in attendance, thank you so much for your time today. And we will hopefully speak to you shortly.
Excellent. Thank you, everyone.
Thanks.